They both start with $10,000. 6 months later, Mike has $20,000, and Sarah only has $10,800. Who's the better investor? Well, just 6 months after that, Mike has lost almost everything. Sarah is still growing her wealth calm as ever. What did Sarah know that Mike didn't? She knew one secret, and today I'm sharing it with you. Hello and welcome to MonsterInvest, the channel where we help you tame the financial monsters that keep you from building wealth. I'm your host, Daniel. Today we're talking about a big one, a monster that lurks under the bed of every single investor, from the absolute beginner to the seasoned billionaire. We're talking about risk. That word alone can be scary. Risk. It's the fear of losing your hard-earned money. It's the anxiety of watching your portfolio turn red. It's the monster that whispers, what if you make a mistake? What if you lose it all? And because of that fear, many people do one of two things. They either freeze, stuffing their money under a mattress or in a savings account where it gets eaten alive by inflation, or they do the opposite. They gamble. They chase hot tips, hoping to get rich quick before the monster can get them. But what if I told you there's a third way, a way to invest with risk but to do it safely, a way to build a harness and a saddle for that monster, and ride it toward your financial goals? That is called risk management, and today this is your 101 class, our topic, how to invest safely. So let's get one thing straight right at the top. There is no such thing as a no-risk investment that also gives you a meaningful reward. Anyone who tells you otherwise is selling you something you shouldn't buy. Saving and investing are a trade-off. In a savings account, you have almost zero risk of losing your money, but you have a 100% guarantee of losing your buying power to inflation. Think about it. If your money in the bank earns 1% interest, but prices for groceries, gas, and housing go up by 4% that year, you didn't lose $1, but you lost 3% of your power to buy things. That is a guaranteed slow-motion loss. To beat that, you must invest. To grow your wealth, you must take on some level of risk. The goal isn't to avoid risk. The goal is to manage it. It's the difference between driving a car 100 miles per hour in a blindfold and driving that same car at the speed limit with your seatbelt on and your eyes on the road. Both have risk, but only one is smart. To really understand this, I want to tell you a story about two new investors. Let's call them Mike and Sarah. Mike is excited. He's been reading headlines, he's on social media, and everyone is talking about one company, TechSpark. It's a new AI-driven, solar-powered crypto mining. You get the idea. It's the next big thing. Mike gets what's called FOMO, the fear of missing out. He takes all the money he saved, let's say $10,000, and he goes all in. He buys $10,000 worth of TechSpark. He dreams of turning it into $1 million. He put all his eggs in one very exciting basket. Now let's meet Sarah. Sarah has the same $10,000. She also has a goal. She wants to save for a down payment on a house, which she plans to buy in about 10 years. Before she invests a single dollar, she asks herself the most important question: what kind of investor am I? Generally, there are three main types. There's the conservative investor who prizes safety above all. They can't stand to lose any money, even for a short time. They'd rather have slow, steady gains. Then there's the aggressive investor who wants maximum growth. They are willing to take on massive risk and see big drops in their portfolio for the chance at the highest possible reward. And then there's the balanced or moderate investor, someone right in the middle. Sarah knows she's not a gambler, but she also knows that money in a savings account won't get her to her goal. She wants growth, but she also wants to sleep at night. So Sarah decides she is a balanced investor. With that in mind, she does what we call a risk tolerance assessment. She considers three things. 1. Her time horizon. She needs the money in 10 years. That's a medium to long-term goal. She has time to ride out some bumps. 2. Her financial goals. This money is important. It's for a house. She can't afford to lose it all. 3. Her emotional tolerance. She knows herself. If she saw her account drop 50% overnight, she would panic. Her choice to be a balanced investor is confirmed. Now she learns the single most important rule of risk management. And if you remember nothing else from today, remember this: diversification. It's the age-old saying, don't put all your eggs in one basket. Think of it like building a championship sports team. You wouldn't just hire 11-star goal scorers, would you? You'd be crushed every game. You need defenders, you need a solid goalkeeper, you need midfielders. Each one has a different job, but they work together to win. Asset allocation is the same for your money. While Mike put all his $10,000 into one single stock, Sarah, she diversifies. She learns about asset allocation, which is just the how-to blueprint for diversification. She decides to split her money into three main buckets, based on her balanced profile. Bucket 1: stocks. These are her growth engine, her goal scorers. They are higher risk but offer the best chance for growth. She doesn't buy just one stock. She buys an index fund, specifically one that tracks the S&P 500. This means she instantly owns a tiny sliver of 500 of the biggest companies in America. If one of them has a terrible day, she's still protected by the other 499. She puts 60% of her money, or $6,000 here. Bucket 2, bonds. These are her safety net, her defenders. Think of bonds as a loan you give to a government or a big, stable company. They are much safer than stocks. They won't grow as fast, but they don't fall as much either. They are the boring part of the portfolio. And in investing, boring is beautiful. Boring is what lets you sleep at night. She puts 30% of her money, or $3,000 here. Bucket 3, cash. This is her emergency fund, her goalkeeper. It's totally safe, liquid, and ready if she needs it. She puts 10%, or $1,000 here. So let's review. Mike 100% in one high-risk stock. Sarah 60% in hundreds of stocks, 30% in safer bonds, and 10% in cash. Who do you think is sleeping better at night? Now the story continues. For the first 6 months, Mike looks like a genius. TechSpark is the talk of the town. The stock doubles. His $10,000 is now $20,000. He's telling all his friends, see, you just have to pick the winner. Sarah's portfolio in that same time has just chugged along. Her stocks went up, her bonds stayed stable. She's up about 8%. Her 10,000 is now 10,800. Good, solid, but not as exciting as Mike's. And then it happens, the inevitable, a market crash. It's not even a huge crash, it's what we call a correction. But for Mike, it's a catastrophe. A bad report comes out about TechSpark. Its technology isn't what they claimed. The CEO is under investigation. The hype was just hype. The monster he ignored just woke up. Mike is checking his phone every 5 minutes, his stomach in knots. He watches the value go from 20,000 to 15,000 to 8,000, all the way down. In 1 week, TechSpark stock falls 90%. Mike's $20,000 is now worth $2,000. He lost $8,000 of his original money. In a panic, he sells, locking in that $8,000 loss. He's devastated. His dream is over. Now, what happened to Sarah? The market correction hit her, too. Her 60% in stocks. It dropped. Her S&P 500 index fund went down with the rest of the market. Her $6,000 in that bucket went down to $5,000. She lost $1,000 on paper. But remember her other buckets, her defenders, her 30% in bonds. They barely moved. In fact, some of them even went up a little because in a panic, people sell stocks and buy safe bonds. Her 3,000 in bonds is still worth 3,000. And her 10% in cash, still worth 1,000. So when the dust settled, her 10,800 portfolio was now worth $9,000, 5,000 in stocks, 3,000 in bonds, 1,000 in cash. Yes, she's down, but she only lost 10% of her original money, while Mike lost 80%. And here's the most important part. Sarah doesn't panic. Why? Because she had a plan. She knew this could happen. Her safety net, the bonds and cash, did exactly what they were supposed to do. They cushioned the blow. She trusts her 10-year time horizon. She knows the market will recover. So she does nothing. No, she does something even smarter. She does something called rebalancing. She looks at her plan. Her plan was to be 60% stocks and 40% bonds cash. But after the crash, her portfolio is out of balance. Her stocks are now a much smaller piece of the pie, 5,000, and her bonds cash are a larger piece, 4,000. So she calmly takes a little bit of her safe money, her cash and bonds that didn't crash, and she buys more of her stock index fund, while it's on sale. This is the opposite of what Mike did. Mike panic sold low. Sarah is calmly buying low according to her plan. She is not a market timer. She is just re-sticking to her original recipe. And a year later, the market has recovered. Her stocks are back up, and the shares she bought on sale have grown even more. Her portfolio is healthy again. Mike is still on the sidelines, his $2,000 in a savings account, too afraid to ever invest again. Sarah managed her risk. Mike was simply gambling. So as we get close to the end, I want to give you that quick summary I promised. What did we really learn today from the story of Mike and Sarah? First, risk is not the enemy. Unmanaged risk is the enemy. Your job is not to avoid risk, it's to control it. Second, you must know yourself. Before you invest, understand your personal risk tolerance. Are you conservative, balanced, or aggressive? Know this before the market crashes. Third, diversification is your single greatest tool. Never put all your eggs in one basket. Spreading your money across different asset classes, like stocks and bonds, is the key to investing safely. Fourth, have a plan and stick to it. A good plan includes your asset allocation and a strategy for rebalancing. This forces you to buy low and sell high, not the other way around. And fifth, time is your greatest ally. The longer you plan to invest, the more risk you can afford to take, because time has a beautiful way of smoothing out the scary, short-term drops. Risk isn't a monster to be slain. It's a powerful force of nature, like the wind. If you don't respect it, it will destroy your ship. But if you build a strong hull and you set your sails correctly, you can harness that wind to take you exactly where you want to go. This has been Monster Invest. I'm Daniel. Thank you for listening. If you found this helpful, please like, subscribe, and share it with someone else who is just starting their investment journey. Until next time, invest smart and invest safely.